for as we always say, the session is purely educational. So whatever we would be discussing today is more of a discussion on Ravi's framework. And if we take any names so as to illustrate the concept or process, should not be construed as any sort of buy, sell, or hold recommendation. For your financial decisions, please consult your financial advisors and take today's learning as a starting point. Please do not act on the names taken during the conversation. So guys, let me take a moment to introduce our guest for today. So Ravi Jain has over 17 plus years of market experience. He started way back in the year 2006, and investing is not his profession but his hobby and passion, right? So he's a CFA charter holder from CFA Institute of USA, and he did his MBA in finance. He's also running a startup, fintech startup, that goes by the name of Blostem Fintech, which is creating secured lending infrastructure using blockchain technology. And his investing philosophy is more governed about the use of behavioral finance and psychology aspects of the market, along with the top down and bottom up technique of fundamental investing. So we will be discussing in great detail about the top down approach and bottoms up approach with Ravi. And he also had made some good calls on macro and market cycle and various sector trends in the past. To name a few, he more or less predicted the beer market in small caps in the year Jan 2018, in the COVID crash, and the 2022 bear market. And he's also identified structural trends in chemical sector in the year 2013, and last to last year in the defense sector. So he had also actively contributed on the value picker forum, and all the names which he discussed on the forum had turned out to be great multi-baggers, and surely that would be part of the case studies which Ravi would be discussing shortly. And he has also like shared his knowledge and experience over various forums, to name a few, Delhi Investor Association, and lately with the Indian Accelerator Summit. So a very warm welcome, Ravi, and would appreciate like if you tell our attendees how it all started for you. And yeah, obviously you can also give disclaimers on your part. Yeah, over to you, Ravi.
Thanks, Prince. Thanks for the introduction and thanks for hosting this space. And good evening, everyone. Prince has already given a brief introduction about myself. Just to elaborate a bit on that. So, basically, my journey for the investment started back in 2006, right? And that time, market boom was going on, but I was more of a novice that time, didn't know much about the market. So 2006 to 8 frenzy I have witnessed as a novice investor, and then after that the crash which happened during 2018. So I witnessed that also, and post that I started learning about the market, did my MBA and CFA and everything. So post that it has been a learning journey since then. But in a nutshell, I have seen various market cycle. I mean, 2006 to 8, bull market, then crash in 9, then slow death of small cap during 2011 to 13, a bull run of 13 to 18, and then after that, a crash, COVID crash, and then a bubble which we witnessed during 2022, and a fall which has been there over the last 18 months. So that way, I mean, I have seen various asset classes, various market cycles. And from that sense, and based on that experience, my specialization is basically to identify inflection point across various asset classes, including equities, right? So I'll be sharing, my investing experience through some examples during the part of the session today. But before that, I mean, a disclaimer that view expressed during the conversation are personal in nature. It would be safe to assume that I may have investment in some of these stocks which I'll be discussing as a part of the case study, right? And but mm, none of the stock name which I'll be taking should be considered as a stock recommendation. One should do his or her own due diligence and consult a registered investment advisor before making any decision. And I'm not a SEBI registered advisor, right? So basically, in terms of my investing style, as Prince mentioned during the introduction, so my investment philosophy is basically to use top-down and bottom-up approach of investing, along with the behavioral finance and psychological aspect of investing, right? So what I'll do is I'll explain the same in different parts. To start with, first I'll cover the top-down approach. So in the top-down approach, what I generally do is basically, you know, I follow a approach called weave analysis, right? So by weave analysis, what we mean is I look at four part of the macro thing. One is the behavioral aspect of the market, that is the B. The second part is the earning cycle, economy cycle. Second part is the economy cycle, and then third is the earning cycle, and then thereafter comes the valuation cycle, right? So any view which I take based on the market is a combination of these four factors which play very crucial role in generating returns, right? So now what I will do is I'll just briefly touch upon each of these aspects. So generally in the behavioral part, what happens is, it has generally becomes easier over the last few years to understand what is crowd or social media behavior is expecting for the market, right? So there are times when there's a frenzy in the market, and there are times when there's a complete panic or pessimism in the market, right? And generally, what happens is these indicators turns to be contra in nature. I mean, to give you an example, during 2020 crash when COVID lockdown happened, that time everybody in the market become kind of confident that market is going to go down, it will continue to go down, and there'll be another crash, nifty will come to 5,000 level, and then economy is going to get shattered and all those things. So there was a complete panic. And even some of the non-investor in the forum, including value picker, I mean, some of the smartest investor there had put a some of the people who generally believed in buy and hold sort of strategies were of the view that market is not going to do well. A lot of investing guru had put out a statement that market should be closed. That was the kind of pessimism at that point of time, right? So which gave an indication that the panic is setting in. So from that aspect, I mean, behavioral aspect is what a typical indicator that it has to be seen from the contra point of view, that whatever general market or the people are expecting, things generally go in an opposite direction. So that's the behavioral aspect of the market, right? Then the second part is the economy cycle, right? So as we know that stocks are generally slave of the earnings, and earnings depend on the economy cycle, right? So we have to see what phase of economic cycle we are into, right? Either are we into the expansionary stage, or is it a peaking stage, right? So you just try to get the economy cycle view. Then third part is the earning cycle, and then obviously the valuation cycle, right? So earning and economy cycle I will not discuss in detail. I mean, since that's a separate topic altogether. But on the valuation side of it, I'll like to touch upon on the valuation cycle. What I have noticed is valuation parameters, some of the parameters which I generally follow, works perfectly during all sort of market cycle, right? So what I see generally in the valuation cycle is two parameters. One is valuation multiple of Nifty as compared to the historical cycle, right? So from that sense, what I have noticed is based on last 15, 20 year data that 10-year price to earning ratio of Nifty is around 18. And generally, whenever market is around price to earning is more than 24, that is a time when market is about to peak. When the price to earning is around 16, 17, 60, 15, 16, that is the time markets are near bottom. And generally when it is around 18, 19, that is at a long term average. So from that sense, looking at the multiple, one can get an idea that what part of cycle we are in. exact top and bottom, but it will give you a pa- fair indication of the timing. I mean, in the sense that which part of the cycle we are in, right? That's the first part. Now, second important parameter is the small cap premium, right? What I understand is as a retail investor, most of the people invest in the small cap and mid cap space, right? So there, what is happening is there's a indicator small cap premium to the large cap, right? Which is basically generally I use. So whenever small cap premium is more than 100% to the large cap, that is the peak of the cycle. And whenever it is less than 50-60%, that is bottom of the cycle. And this parameter has worked perfectly during the 2018 top, then 2020 bottom, 22 top, and then the recent bottom. So, and this worked perfectly back in 2009 bottom also, 13 top also. So this ratio has worked very perfectly across all the cycles, right? So if you combine both these valuation parameter, then one will be able to get a fair idea of valuation cycle. And so that's about the top down macro approach. What I will do is, I mean, the second part, I would like to cover, some of the macro themes also. But before that, I'll just take a pause, just to sense, I mean, if anybody has any questions or, I mean, and, want to understand specific on this part. So I'll just take a pause here.
So, Ravi, as and when we'll be getting requests for questions, I'll take that view. And in the meantime, if I have any question, then I'll also stop you and ask that question. So, in the meantime, we can continue with the next thing which you want to discuss.
Sure, sure. Okay. So that was on the, basically top-down macro approach, right? And probably we can take a couple of example later on. Now the second part of the thing is in using the top-down approach, how to identify a theme, right? So what I do is basically using the macro environment or sector tailwind. There are few sectors which I try to identify, which generally, become flavor of the season, right? So what I'll do is I'll give you a few examples which I have used in my investing journey over the last few years. So the first example is the chemical sector example. So what happened is back in 2013, 14, China was implementing a lot of environmental protection things back in 2014 and 15. As a result of which, a lot of chemical plant shutdown were happening, right? And then a talk started amongst the industry bodies in India that this sort of shutdown is expected to benefit the companies in India as well, right? And then a lot of coming out, right? Primarily, a good report got released by Philip Capital back in 2014, which kind of talked about all these possibility of these trends in 2013. Then what I did is, I mean, at that point of time, since this indication was available in front of us, I did some study. I looked at a lot of listed Chinese company, went through their con call and annual report and witnessed that, noticed that, this trend is for real, that a lot of these shutdown is actually happening, right? And then this trend can actually be good, right? So from that sense, indication was there that there can be a possibility of a good trend in the chemical sector. And to validate, there was a validation when listed companies were talking about that in China. Indian companies started talking about it. So there was an indication there's a theme, right? At the same time, what was happening is that chemical as a sector was most neglected sector at that point of time, and most of the stocks used to be available at around 7 to 8 price to earning on a depressed earning and margins level. I mean, the companies, the big companies like Aarti Industry, Atul Industries, and these SRF, the leaders of the chemical industry as of now, which are at 20, 30, 40 price to earning, they were available at a 7 to 8 price to earning. So there was from that point of view, risk reward were clearly favorable, and so it was looking like that chemical sector is doing well. So what we did at that point of time is we did a basket approach of buying. I mean, so there was a theme, but we didn't know what to buy and what not to buy. So during the first leg of up move, there was a basket buying, and then what happened is, sector by sector, I mean, specific segment by segment, trends started coming in, wherein a particular segment was of more more beneficial at some point of time, and some other segment at some different point of time. And that way, I kind of kept on churning and moving in and moving out between the different segment during that period. And that way, 2013 to 18, 19, these 6, 7 years were kind of really good for the sector. Just to give a data point, during 2013 to 19, 6 years, out of more than 100 listed chemical stock, if anybody had randomly picked up 10 to 15 stock randomly, that would have given a CAGR of more than 50% in the chemical basket itself. And if somebody was kind of choosy and somebody would have read about the companies or would have bought the leaders and all those things, then obviously CAGR would have been much much higher than that, right? So so that's the power of picking up a sector at a right point of time, and that way chemical was one sector. Then then another example I would like to give about the 2020 example of the IT sector, right? When this COVID shutdown happened, right? So we all know how things were at that point of time, and but a trend became evident by May or June 2020 when all the people started talking about, I mean, started exploring work from home environment, and this Zoom call digital things started accelerating. And at that point of time, every company realized that IT is the thing to go, and we have to IT spending, right? So there was a clear evidence that IT as a sector, as a demand will pick up. On the other hand, what happened, people started talking about a trend that since things will be digital, and for the IT companies spends are mainly two overhead. One is the salary, and one is the basically overheads for the staff in terms of the travel or office and other things. So one trend was which was quite visible is that on these overheads companies would have to spend lower money. So that way basically margins would start increasing. On the other hand, demand will also increase, right? So from that sense, there is a clear evidence that IT as a sector will have a tailwind in terms of the demand as well as margins, and then operating leverage will kick in and earnings will explode. And on this other side of it, because of the COVID, all the companies were available at a single digit P. At least the mid and small cap IT companies were at a single digit P, and large cap were obviously at a double digit, lower double digit. So that way, IT was another sector which using this indication one could pick up. Then the other sector, I mean the defense sector. So I'll give a pointer. So basically, I'm giving this pointer just to understand what all things to look at when picking up a sector. So basically, what happens is you will have the indication in place. Either it will be led by the government policy or led by some macro events, or it could be due to some demand shift, right? So there will be a tailwind in place which will actually drive the demand for a sector, right? Similarly, over the last 3, 4 years, we have noticed that government has actually come up with a PLI scheme, right? Because of which manufacturing as a sector is taking a good shape, and then in various segment demand is happening. Then the other segment is actually a defense, right? And now we have to understand the defense, how things started picking up, right? So in the defense sector, when this Russia and Ukraine war started, so before that, I mean, just go back before that itself. So what happened is, I mean, post COVID, world understood one problem that everybody started hating China. I mean, in some way or other, right? And kind of China plus one theme started emerging, right? So that was a trend which was clearly visible. Then what happened is because of the Russia and Ukraine crisis, right? People realize that one cannot rely on their partners. I mean, their defense partner, and you have to have resources. You have to have a defense equipment, army, and everything on your own if you have to protect yourself, right? So that acceptance started coming in post Russia and Ukraine war, and then if somebody had to buy the equipment, right? Nobody wanted to buy from China. People couldn't buy from. Nobody wanted to buy from the Russia because of the sanctions and other things. If you have to buy from the US, it is expensive, right? And then then where do you buy it from, right? So that is where basically And what was happening is over the last few years, Indian government, due to PLI scheme and a lot of other things, defense they were making a policy that things has to be indigenous, defense product has to be manufactured domestically, right? So from that sense, there was a clear push from the government side of it as well. So domestic demand was actually was being met using the domestic source. And from the some of the smaller countries like South Asian smaller countries and other countries, they started exploring India as a nation where they wanted to procure defense product. So that is where defense themes started picking up for this Russia-Ukraine war. And then all the major companies have been a beneficiary of defense themes. So all lot of stocks. I mean, if I name, I mean, HAL is a leader in the aircraft, then GRSE, and so basically, in a nutshell, I mean, defense as a sector, these were kind of trigger, and then a lot of stocks did well post that, right? So the idea is, and then if I talk about another theme, which is the electric vehicle, we all know that over the last 2 3 years, electric vehicle as a theme is picking up, and everybody wants to have a green focus at the government level as well as the industry level. So from there, if you look at, I mean, although the last 18 month market has not done well, but stocks in the EV theme has done relatively well. So the idea is that you will get a lot of indication either because of the government push, because of the geopolitical crisis, or because of the environment. You will have some sort of hint, right? You have to dig deeper into those hints and probably build up to the positions. And but full clarity will come over the time. I mean, it is not that on first day you will get the full clarity, but there will be indication, and you have to watch out for those indications. You have to make your notes that what are things you are looking at, and then probably over the time, your conviction will get built up on those themes. So that's the
Ravi,
example of how to yeah.
yeah, so Ravi, I'm have few questions in the comments, and parallelly, some people are complaining like they are unable to listen. Although I'm clearly able to listen to each and every word what you say.
Mhm.
So Ravi, like, shall we continue with this, or shall I drop and join? I mean, start again for the benefit so that people should not get dropped. How you want it? I mean, it is clear for me and many of us, but don't know. Few comments are saying like they are unable to hear.
Either way is fine with you, Prince. I think I mean connection at my end is fine, but I mean I'm fine either way.
Okay, so guys, those who are facing problem, if you are able to listen to me, I'll drop and start within a minute. So please join again. And Ravi, I share the link when I start within a minute.
Sure, sure.
Okay. Okay. I hope I'm clearly audible this time, and we don't face any similar issue this time. And in the meantime, Ravi, I sent you this. Okay, you're there. Am I audible now?
Yes, Prince is fine.
Okay. So Ravi, there was one question on like how to calculate the premium of small cap over large cap. So this was one question one speaker was asking previously.
Yeah, yeah.
And before we start, like our attendees can tell us in the comments. This time, I think you would be able to listen to Ravi clearly. Please comment and let us know. Yeah, well audible. Ravi, as and when you feel comfortable, please you can start on your end.
So basically, so the question was on the small cap premium, right? So there are various combination of things which I use to calculate the small cap premium. But if somebody has to mimic that chart, basically what one can do is he can basically download the data of BSE small cap from 2004, and similarly Nifty 50 data from 2004. I mean the index data, indices number from 2004, right? And then he can rebase the Nifty 50 and Nifty indices level and the BSE small cap level to 100 in 2004, right? And then from there, one can calculate the indices level, whether it is 120, 130, 130, 150, 200, and so on. And then the BSE small cap level compared to Nifty level would give you a premium or discount, right? So that's the way to basically, in a simple term, if somebody has to calculate premium ratio, right? What I do is I use combination of few other factors also, but it will be difficult to explain and difficult to implement. So, but for the simplicity, if one has to implement, I mean, I think that is the best way to do it.
And Ravi, like one question was around the China plus one thing because that people see that as a big mega trend, right? So how much of
Yeah.
it you think is already on ground, and how you are seeing it panning out going from here?
Yeah, so basically, with China plus one thing, if you look at this theme, actually started back in around 13 in the form of chemical and then textile and then commodity. And this trend accelerated in 2020, right? I mean, because of the COVID and other things. So I would say that major part of the theme from the major delta point has already played out, right? But obviously, so the major delta I would say is already played out. But some steady incremental market share India will continue to grab from China. So that way, theme is there for us for the next a decade as well. But I would say that major delta is out of the way. So the probably the sectors which had to witness re-rating because of that, that has already played out. Now it will be more on the earning part. And with the earning also, what would happen is it will more be company specific, right? So that's how I see the trend. And one more thing I would like to add here is that whenever any new trend start, right? So the major alpha gets created in the terms of re-rating, which generally gets finished in the first leg of the journey. In the second leg of the journey, you have to be very specific within the segment as well as the stocks, right? So I believe that first leg of the journey has completed. So probably we are into the second leg.
Right. So when you say like we are into second leg, so in that case, you still prefer a basket approach, or you will be, I mean, going specifically for stocks in that case?
No, you have to be specific. I mean, you have to be specific from the company perspective. You have to look at a company who is probably a leader in a particular segment, right? Right, and a strong moat around its product and have expansion plan and all those things in place. So you have to be specific. I mean, in the first leg, what happens is, I mean, even if you don't be a company you have a good jump in the form of sector basket, right? I mean, every stock in the sector kind to have a re-rating, right? But in the second leg, you have to be company specific. So there, I mean, the company management, company product, its competitive edge, and all those things will come into picture.
Right, Ravi. So Ravi, we can continue with the topic next topic you want to discuss. Yeah. Then we have questions around.
Yeah. Yeah, so basically in the first, I mean the last 25 minutes or 30 minutes, I mean we discussed briefly on the top-down approach. Now, I know that that is kind of boring also for some people. So what I'll do is now in the second part, now I'll discuss on the bottom-up approach of investing. And within the bottom-up approach of investing, I'll not discuss the basically key ingredient of a good stock because that is well and widely discussed topic. Rather, what I'll do is I'll discuss few strategies, right, which I generally use to find a stock, right, or a few themes which I generally use to find a stock, so that I mean it will be easier for somebody to use that, right. So first and foremost strategy to find a multi-bagger stock is I call it as a PEAD, post earning announcement drift, PEAD, right. So what happens is whenever there is a turnaround for a company, right, that turnaround should be visible in the quarterly result of the company, right? So in every quarter, I mean, we obviously have 1,000 plus companies reporting result, right? Out of that, what happens is there'll be few companies who would have a turnaround result due to multiple factors, right? It could they did some capex or they have hit some milestone and then that plant got commissioned. They might have won some contract or some changes at the company level, right? So they will get visible. They will be visible in the quarterly result of the company, right? So that way, and you have to look at those results basically, right? So if you go through all the results in in today environment, I mean, there's a smart way of going through result. I mean, if I can give an example, there's a very good website called screener.in, right? And if you have a subscription of that website, in a day, even if 300 companies are reporting result, in 15-20 minutes, out of the 300 companies reporting result, you will be able to filter out 4 to 5 companies in just 15 minutes, right? And once you have those 4 to 5 names, you can obviously go through the result PDF and try to see if you are finding some, interesting results, right? So that is a one strategy. And now to elaborate more on this strategy, I'll give an example of few stocks, right? So there's a company called Sheila Chart Technology, right? If you have screener in front of you, probably you can open it to see how things panned out in this particular company. So basically, during December 2021 quarter, so result got declared back in Feb 2022. Result net profit exploded like anything, right? And after the result, what happened is stock basically on the result 250 to 350 happened within 10 days. After that, from that result till the next result also, stock went up from 350 to 450. Then March 2022 result was also good. Post that result rallied to 450 to 700, right? And after that, quarter on quarter company has been posting a better result. Then now the stock is 1500. So 250 to 1500 in 15 months. It has been a six bagger stock in 15 months, and the trigger was the result. First result came good, then the second result came good, third result also came good, and that way company kind of kept on rallying, right? Now in this company specifically, advantage was this that at that time when they posted this result, price to earning ratio was also relatively less. I mean, it was around a single digit P at that point of time. So one kind of had a favorable risk reward ratio with him that if company in case doesn't report good result next time, that you won't lose much since it's a cheaply priced stocks, right? So that was a one trigger, right? Obviously, you have to you have to dig deeper. If companies does con call, you have to try and understand that if generally this is one way of looking at it. Similarly, there are some other companies. There's this company posted a very good result in December 2021 quarter, and stock has been a four bagger since then, right? Then there are multiple other there, KPI Green is there, WPIL is there. Many companies in the last 18 months, when market has been bad, these stocks have been a multi-bagger, and the primary reason is the which I believe that is a very easy to explore in the result season. You will get some stocks which post stunner result, and that will be a starting point for you to read on those company and probably have some starter position. So in this case, what happens is if these trends are for real, then these tech stocks generally tend to be 3 to 4 to 5 bagger over the next 12 to 18 months. So it is not necessary that you build up your entire position initially itself, right? So you maybe start with a tracking position, start reading about the company, you see the next quarterly result, and if things are playing out, you can keep on averaging on the upside, right? So the idea is not just to buy the stock at a bottom and but to probably buy a stock at an inflection point, right? So from that sense, this is one of the strategy post earning announcement drift which I generally use, and through that probably in a quarter, 3 months, probably you can find couple of stocks every quarter. So this strategy itself can give you a good multi-bagger. So that's the first theme within the bottom approach I use. Now the second theme is actually management change and the companies which are coming out of NCLT, right? So generally what happens is every again, I mean, in the social media you keep on getting various filters these days, that and you'll get to know easily that wherever company changes is happening, I mean management change is happening in a company, right? So whenever there's a management change in the company, the new management who is buying this stock, I mean he obviously is buying that particular company with some objective in mind, right? And in most of the cases, 80 to 90% of the cases, it turns out, I mean data says that in those cases, I mean you tend to have a multi-bagger in your kitty if you are able to find out those kind of stocks. And we have multiple example in front of us, right? If I talk about 2022, there's a company called Imagica. which had various problem in his previous avatar, and when new promoter bought it, stock turned 3x within 6 months. Then there's another company called APM Finvest, right? So this APM Finvest was kind of dormant company, dormant NBFC company, and one strong group, Hindan Group, which is Mufin Green Finance listed company as of now, that company. And and when we did some inquiry about company, promoter background is really good, and they had a lot of plans in place. And post that, I mean, that company also did really well. I mean, stock went up from 50 to 250 within a year, right? And similarly, there are various other examples. CG Power, around 3 years back, CG Power came out of NCLT, and the people who track that sector would know that CG Power as a company had a good asset in its kitty, but they went into trouble because of the group debt which was there at his books, and the promoter issue which was there. But once Murgappa Group acquired it, right, and people would know that how strong is the Murgappa Group, so that way it became quite evident that the asset is good. Now the company has got into the good hand, so probably it will do well. And that way, I mean, it has done really well. It has been 20x in 3 years. Similarly, there's a company called SFinserv, right? So this company got acquired by APL Apollo Group last year, right? And post that again, that stock has also done well. And if you go back to the past, I mean, 2, 3 years back or 5, 4 years back, there have been multiple stock, right? So wherever management change happens, or any company who is coming out of NCLT is going into the other hand. Ruchi Soya is another example, which is Patanjali now. So these stocks tend to give a multi-bagger return, right? So that is the second strategy or filter for you to basically find out stocks. Then basically third theme is the demerger theme, right? So although of late, I mean, over the last 6 months to 1 year, this demerger theme has started, giving a bad result also, because now this theme has been most talked about theme in the social media. But otherwise, if you look at last 5 year data, demerger theme also gives a very good return. So what happens actually in the demerger theme is this, that there's a company, large company, that large company has a business, and then they have a small part of the business as well. And then what they want to do is they want to have a separate companies for both the business, so that there can be a focus on a particular business, right? Because of which they do the spin-off or demerger, right? Then what happens is post this spin-off or demerger, right? The companies which is relatively small, right, kind of sees forced selling by the mutual funds, right? Since mutual funds have a mandate that they do not want to hold a company of a less than, let's say, 1,000 crore market cap or 2,000 crore market cap. So post the demerger, they will have a smaller company, and they will get out. They will like to get out of those stocks at any price, right? They'll be forced selling into those stocks, and when the forced selling happens, the stocks continuously hit lower circuit, and some point of time it will become a undervalue, and probably that would be a time to get into it, right? And in some cases, what happens is there may not be a forced selling, but the business is lucrative, that it has some specific advantages, and then stock does well. Some of the example of this, if you look at, I mean, there's a company called Solara which got demerged back in 2019, right? And then within 2 years, stock was 9x. Similarly, Borosil Renewable, right, got demerged out of Borosil Limited, right? And after it got demerged, it was a lucrative business from the sense that in the renewable, again, I mean, we all know that renewable as a theme has been the flavor of the market over the last few years. And as such, this company is the only pure play company in that theme, basically. So from that sense, this stock again went 7x in just 1 year. Similarly, Faircam Organics, Jubilant Ingravia, and multiple other companies, right? So host of those companies in this theme actually does well, right? So so that's another theme. Earlier, there used to be a theme on the reverse merger, but now over the last couple of years, nothing much has happened into this theme. But otherwise, it is important to keep in mind that if there is a reverse merger happening, then those companies create good wealth. I mean, if I have to give an example, there's a company called Vari Renewable. Earlier, it used to be known as Sangam Advisor. This Sangam Advisor company was acquired by Vari Group, which is a very big group. And post that, they renamed the company to Vari Renewable, and then stock has been again a massive multi-bagger over the last 3 years, right? So reverse merger is another theme, right? Apart from that, there are multiple small look at to find out turnaround in the business. Then what happens is these days we all know that a lot of companies doesn't show good numbers, right? But when next generation entrepreneur comes in, I mean, and he has studied from a reputed institute, then he has a thing in mind that I don't want to siphon money. I want to put it. I want to show good result, and then probably market cap game is what I want to play because that will give me a better wealth than siphoning money, right? So what happens is when the next generation takes over the company, right? That is also the point of time to look at the company to see if there is any change happening in the corporate governance practice of the company, and if yes, probably you have to dig deeper and then uh, look at those stocks, right? Then the other thing to look at, I mean, is obviously management signal, right? A lot of time we see huge insider buying. I mean, see, corporate keeps on buying their stocks, right? So you cannot look at all the stocks, but if you see an unusual activity or a significantly increased insider buying, then probably that could be a point for you to look at that what is happening in the company, right? So I think these are some of the things which will give you basically initial pointer to initial tracking position for you to have in a stock, and then probably you keep on analyzing and then have a uh, returns in place. Yeah. So that's on the basically bottom up approach of investing, if I have to say. Obviously, there's a lot of things which I can talk about, but I mean. I don't want to give a lot of data points, so that you guys don't get confused. So that's on the bottom approach. Yeah.
So Ravi, I mean, prior to this, we talked about the identification of early trend in chemical sector, right? So chemical sector
Yeah.
is linked to many other sectors, so that structural trend is quite long. But if we talk about the defense sector, right? So how long the
Mm.
runway can be, how one can identify that? Because as you said, like in the first leg of the run, most of the price is already most of the what we say make trend is already priced in, right? And after that
Right.
there has to be like stock specific search in that sector. But how we can I mean identify on how long it can last?
Yeah. So basically, Prince, I mean, if you talk about particularly about the defense sector, right, and if you look at the dynamics of the world, right, so there are two ways to look at it. One is the domestic demand and one is the export demand, right? Within domestic demand, I mean, we all know that we have a pretty big budget for the defense in India, right? And out of the that defense budget, and we used to import a lot of products from other countries, but now there's a clear mandate from the government that everything has to be domestically manufactured, right? And that way, the entire budget of defense, which is pretty good amount. I don't have the number in front of me as of now, but it's a pretty good amount, right? So that defense budget will go to the domestic companies, right? Within the domestic companies itself, if you look at the companies, there are massive players with. I mean, if you look at the HAL, Hindustan Aeronautics Limited, I mean, they are going to raise this Russian jet and then Rafale as well. Uh, so from that sense, they have a massive opportunity in front of us, in front of them. And in fact, if you look at their order book, they already have a 7 to 8 years of order book in hand, right? So that's about the HN. Similarly, if you look at the shipbuilder like GRSC and Mazadoc, right? They also have a 7 to 8 year sort of order book with them, and then defense budget is going to increase gradually, and they will get that demand also. So that's only bigger products basically. Now, if you look at smaller companies, some of the smaller companies which make missiles and other, so there also the government mandate is clear that they have to procure missiles and other things domestically, right? So there's a massive, domestic demand which these companies has, and at the same time, export demand is also coming up, right? So from that sense, if you look at sector, I mean, I believe that this sector is going to do well probably for the next 5 to 10 years, right? And the defense as a sector has just started picking up. I mean, probably it's a just 1.5 year or maybe 2 year old trend, and this trend is going to be massive for the next few years. So from that sense, you have to look at basically market opportunity. You have to look at from where the massive revenue growth will come to you, and is there any and where are we in terms of that cycle? So probably the chemical, as I mentioned, we are 9 year old cycle, right? But this defense is probably 1.5 to 2 year old cycle only, and then we have the data in front of us that this is 7 year, 7 to 8 year order book these companies already have, and then demand is also expected to be good, and basically new order also expected to be good. So that way, there's a good runway for us at least at this point of time.
Ravi, any other sector in flavor which you think is presently in a position where defense was 2 years ago, or maybe we can say the chemical sector was there in the year 2013? Any
Yeah,
similar thing?
yeah. So electric vehicle is another sector which is probably a 2 year old trend itself, right? But there the challenge is some of the good companies which are there, they have already run up a lot and probably the EV sector. If you look at, there are a lot of private companies which has come up. So probably the competition will also be a lot. So from that sense, I see that from a trend perspective, EV segment is going to do well even in the next 5 to 10 year perspective. But if we have to find out a stock from that space, probably that's a difficult task. Within that also, there are few companies who are niche companies and have a leader in this space, which can do well. So just to give an example, just to give some pointers. So within the EV also, there are different ways to play it. One is the OEM, you can directly play, but there I believe there will be a lot of competition. And the second way to play it is to play through the ancillary. Within the ancillary, there are a couple of companies like Steam and Sterling Tools who basically provide some products to the auto OEMs, right? So they have done well over the last 1 year, right? So probably if they continue to get orders, so probably those companies can do well. And the third segment is there are companies which make shunts for the EV segment, right? And there are only very handful of players in India, a couple of players, listed players. So probably those companies may continue to do well, right? So that way, I will say that EV is the space where trend is just 2 year old, but one has to be really careful in selecting stock in this sector.
Right. So, Ravi, let's move on to like where do we look out for these data points?
Yeah. See, in terms of data point, so basically what you have to do is, I mean, if I talk about this trend, see, I'll say a single source for any trend, any stock or anything is the BSC announcement. I mean, that is the Bible of anything, right? So what happens is whenever there's a BSC corporate announcement, right? So any trend gets visible from there, right? That BSC corporate announcement will give you an idea about the uh, company result if there's a turnaround in the result. That will give you an idea about if there's a demerger in the company. That will give you information about if there's a management change, insider buying, or anything, right? And then in the BSC announcement itself, you will get the transcript. If you don't listen to the transcript live, then that is the place where you will get the transcript also, right? And let's suppose if you read a transcript of 10 companies, 10 defense companies, and out of 10, 6 to 7 are talking about a theme, then you can believe that at least the industry is believing that this trend is going to be there, right? So from that sense, I will say that BSC corporate announcement is the single source which gives you a lot of things. Now, to do things smartly, there are different ways of doing it. For example, I mentioned that it may not be feasible for everyone. to go through 200, 300 results every day. So there are tools available. Screener is the website wherein you can see all the result in 15 minutes, right? Similarly, right, concalls, there are different, reports keeps on coming with some scripts. So you can have to go through that, right? Then, in these environment, I mean, wherein we are living in a social media world, right? A lot of things keeps on coming on the WhatsApp or Twitter as well, right? And if you notice something really unique, probably you need to dig deeper, right? So that way, I mean, I believe that these are the sources to look at, right? BSc announcement is the source to look at, but then there are smarter ways to do it, for which I have given some examples. Then for the industry reports, right? For the industry trend, the other way to look at is basically, nowadays a lot of these brokers also come up with the report very frequently, and these reports are also available freely at different places, right? So if you keep on, exploring different things, you will get to understand, kind of trends or themes which are emerging. So I think that way, I would say that information availability is not a challenge in today environment. It's just that you have to be selective. You have to pick your niche, right? There are 20 ways to make money, but you have to choose your niche and probably pick up two to three themes or two to three strategies, and you have to master those strategies. I mean, I would say it that way.
So Ravi, like the information which is in public domain doesn't provide any edge, and as we are more and more information is available, then the chances of finding mispricing gets reduced. So how you view it? Like, is it like some pattern around this? Key, if there is a euphoria in the market, in that case the things would not be readily accessible, in the sense like mispricing won't be there, or when there is some good correction in the market or some bear phases around, then you find so many bargains. So how you view it on the aspect of mispricing?
Yeah. See, so that way, Prince, I mean, what I will say is mispricing is has always been there in the market and will always be there in the market, right? But now what has happened is since information availability and dissemination is really fast, right? So what has happened is, the factoring of the information is really fast in the market. So that way, I would like to share a few pointers on this point. That if you look at basically stock market volatility over the last few years, especially 3 4 years, has increased a lot, right? And basically, post COVID, if you look at digitization penetration has also accelerated, as a result of which all this information dissemination is very fast. I mean, when company declare result within 10 minutes, everybody will get to know, right? Now, because of this, what is happening is the factoring of that information in the stock price, which in during 90s used to happen in probably a decade, right? Or starting in years in until 2020, and then probably post 20, what is happening is that factoring happens within a month or within a week, right? So that way I would say that one has to be fast in the action, right? If somebody believes that I have found this stock or this theme and I will read on this over the next 10 days and then participate, then probably by that time that mispricing would have gone. So one important change which one needs to adapt to and understand is that one has to be really fast in entry and exit, right? It can be a stock specific entry exit, it can be a sector specific, or it can be a market specific, right? So that way, I believe that till the mispricing is there,
Yeah, Ravi, you got on mute, I guess.
yeah, yeah, yeah.
So
But were you able to? Yeah,
yeah, you were audible to me. Yeah.
yeah, yeah, yeah. So that way I'm saying, I mean, that way, I mean, one has to be actually fast in the action, right? And probably the mindset which people had that buy a stock and forget it for years has probably go now, yeah. So that time is also over. And probably now everyone has to be more, and whenever there is a peak of this recovery, market has to be very fast. And probably you can exit a little earlier also once those triggers are known. So there has to be change in the mindset, there has to be change in the action, and one has to be agile to take advantage of these mispriced correction. So
So Ravi, you talked about exit. Like one should be fast as far as like entry and exits are concerned. So basically, the sell thing and exit things are
right.
full of regrets, and people often like even I have seen experienced people struggle a
Hello,
lot when. Am I audible, Ravi?
hello.
I think some issue. Ravi, I dropped an inviting you again. Like I was not audible to you, so there was some glitch. Please accept the request again, and the attendees in the meanwhile can confirm whether I'm audible to them or not. Ravi, if you could hear me, please accept the request. You were not able to listen to me, so I moved you down and inviting again. Ravi, I can see you as a listener. I'm not sure I'm audible or not. Let me check with him offline. Please be there. Am I audible now, Ravi? Yeah, Ravi. Fine. It's audible now.
Yeah. So Prince, I lost you on when you were asking the last question. So if you can repeat that.
Yeah. So the question was around the exit or to say sell strategy, right? So
Yeah.
basically, selling is a very difficult task in the sense it always comes with regret. Like people feel like either they sell early or they are too late selling a position, right? And as you say, the information dissemination is so fast these days, so one has to be very quick about it also. So what exactly see like technicals play any role in that, or it's like purely on the basis of fundamentals only you go about it?
Yeah. So basically, what happens, Prince? I mean, there are different ways to look at the exit strategy, right? So what happens is, the first important point to understand is you have to understand, which part of the market cycle you are into, right? And that way you have to plan your exit, right? So if you understand that you are at a later part of the market cycle, nearing the peak, then probably you need to have a conservative approach at your portfolio level, and probably you need to have some cash in your portfolio. And if you see signs of market picking out, probably you have to have some cash in your portfolio, or probably you need to change beta of the portfolio, right? So that's the one way of looking at the exit at the portfolio level, right? Then the second part of the exit is on the stock specific level, right? So what happens is, generally what I do is, whenever I buy a stock, I kind of try to get into the stock very nice, see a potential of a re-rating as well as the earning upside, right? So I kind of participate in those stories, so that even if I am right on one side of it, then the returns are there on the table for us, right? So in that sense, what happens is, and if we are right on our thesis, generally as information dissemination is fast, then stocks sees appreciation really fast, right? So there'll be a time when you will notice that the relating part is over, and probably some part of earning upside is also over, right? So there'll be a time when risk reward will not look favorable for you in those particular stocks. So that is a time to exit, right? Then third thing, what happens is, there'll be a time when there's a frenzy amongst a particular set of stock or a theme, right? So what people will start doing is, people will say that this stock is available at 15p or 20p, but I know that these kind of stock can get a 40 price to earning, right? And I know that earning per share for this company 20, but in a optimistic scenario it can go to 40. 40 to 40 is the 1600 kind of target, and that way I see a good upside, right? So there you will notice a pattern that I call it this way, that when the expectation of peak earning is kind of peak out, right? Then that is a point to exit out of the stock, right? So from that sense, although the actual earning may peak out after a couple of quarters, But now, since people have started talking about that, in optimistic scenario, this will be the earning and this is the multiple and this can be a target, right? So then what will happen is the last leg of the journey would happen in those stocks, and there'll be very very soon time will come wherein those kind of stocks will see distribution, right? So from that sense, you have to assess those situation and exit at that point of time, right? Then the fourth part is, when you have, let's say, 15 stocks in your portfolio, right? And you know that out of these, major juice is out in these five stocks, and probably, in these 10 stocks, there's a still good upside. And then if you come across a better story, then there is a point of time when you get out of those five stocks, right? So in a nutshell, I would put it this way that it is not very important. It is not wise to extract the maximum juice out of a particular script, right? The idea is to probably enter at a opportunistic time and then probably exit up slightly earlier than the crowd, rather than regretting later, right? And at the same time, it is a function of market cycle also. The market is euphoric, and you are sure of the view that market is going to do well probably for next 2 years. Then probably you can stay put. But otherwise, you have to get out before these things happens. And then one other indicator which I have started using over the last couple of years is what happens is sometimes a stock becomes too easy for everyone to say that it will be a multi-bagger. Everybody in the social media start talking about it, right? So trade becomes crowded. So when a trade becomes crowded, so what I've seen is those investment or stocks generally do not give you good return. So probably that is also one indication one needs to get out of it, right? So we have multiple example in front of us. India Bulls real estate. I mean, when this demerger were happening, a lot of people played this story earlier, but a lot of late entrant got into the story late, and then things didn't work out. Similarly, there are a lot of examples when everybody get into a one sort of theme, right? Pharma, we all know what happened, right? Back in at the end of 2021 or mid 2021, pharma, a lot of things used to be discussed on the pharma across the social media, and that is a time when pharma things topped out, right? So probably when a particular theme or stock, gets talked about a lot across the social media, or the expectation from a particular stock, increase a lot. So that is a time to probably get out of those things.
Right, Ravi. So, Ravi, is there any segregation on the part of any core portfolio or satellite portfolio, or is it like a single portfolio in which you apply the strategies which we discussed previously?
Yeah, so basically, what I do is, I mean, in the sense that whenever I come across the triggers, be it on based on the strategies which I discuss, or be it on the top-down approach, right? I take a starter position, probably 2 to 3% of the portfolio in a stock, right? And then start reading about the stock, right? And as I keep on reading about it and probably get to witness the triggers which I witnessed, if those triggers are actually getting materialized, then we keep on increasing allocation to those stocks. So that way, I will say that there are around 8 to 10 stocks which are into 2 to 3% basket and as a satellite part of it, and remaining with a higher allocation are relatively those stocks wherein things are actually playing out in a good manner. And then what I do is, sometime I do take a position just based on just based on the initial screen, and there's a good possibility that I may not have read about the company, but I do take the position wherein I see that this trigger may give me some return in the short term, and if it turns out that the stock is, I mean, the kind of basically the triggers which I was looking at may not actually materialize, or company is not fundamentally good, then I exit from those stocks. But I do get in before doing the research, and the reason is this, that if I spend 1 week studying the company and the company was actually good, then there's a good possibility that within a 1 week the stock would have run up already, and I may miss on to that opportunity. So that way I try to be agile, and that way satellite part of the portfolio helps.
Right. So Ravi, how had been your experience with a forum like Value Picker, and what would be your advice to our attendees now, like how they can benefit maximum out of it, in the sense like if they have they access the forum, so which way they can participate and learn it to their benefit.
I believe that, I think it's a really good forum for somebody to start with, right? And there are two ways to look at it. One is what somebody can do is, I mean, yeah, they can look at the stocks which has done well over the last few years, right? And then can look at it and look at the those forums at the value picker, then how discussion started on that forum, how did people analyze it, and then how things actually played out. So what will happen is that way they'll be able to relate that when somebody initiated a thread, right? Then how things were at that point of time and how things actually played out, right? So that will give us a detailed case study on a stock, right? That if stock has turned out 20x, then how things were at that point of time and how did people perceive and how things are now, right? So that will give a fair idea about the thing. So that is one way of looking at it from the learning perspective. Second thing is whenever somebody is coming across a stock, right? And if there is a value picker thread, if somebody goes through the thread, he will be able to understand all the things about the company in very short period of time, right? And he will have a fair idea that what all things one needs to look at, what which are the negative in the company and how things are happening. So that way, I believe that it's again a smart way of doing things, right? So, so it's a really good forum. And if somebody has to look at, probably, there are 3 to 4 stocks. I mean, I initiated thread on the value picker on 3 to 4 stocks, right? And their story has played out almost the same the way I anticipated it. So there's a company called Stylem. On that stock, I initiated thread when stock was around 60, 70 rupees back in 2014 or 15. So it's around 1200 now, 25x since then. But the third that I initiated, there was a few themes or few story. And if one goes through that, I mean, and then look at the last 5 year company result or re-rating, they'll be able to relate that, how things have happened. Second stock is the Amulya leasing, which is known as Apollo Pipe now. So there's a thread available for that also, right? That was a reverse merger theme, right? So reverse merger theme and good group. So so they will be able to relate there also. And third company is high tech pipe, right? So on that also I initiated fair. And then the fourth company is the Thirumalai Chemical, right? So I think I initiated thread only on these 4 stocks on Value Picker Forum back in 2015-16. So one can go through the initiating thread, the first post basically, and then see, how things have panned out, right? Apart from that, there are various other players or various other people also there in the market. I mean, who keep on initiating thread on the value picker, and I mean, those will give really good insights.
Right, Ravi. So, Ravi, let's discuss on valuation primer, and then we take few more questions. And for our attendees, like if you have any questions, so feel free to send in a speaker request or simply type in a question in the comments. I'll read it out to Ravi. Yeah, Ravi.
Yeah, so basically what happens is, Prince, I mean, I give very, a lot of importance to the valuation actually. I mean, that can be for the stock entry exit or that can be for a portfolio entry exit, right? So that way, what I do is I have a mental model in mind for the valuation. So that way, what I believe is that India as a country, right? If I talk about, in terms of nominal growth, I believe that, double-digit growth is what India as a nation is going to witness over the next 5 to 10 years, right? So that way, on that basis, on a reverse DCF basis, if I can say, right, I believe that a fair multiple for the Indian market is around 18 to 20 price to earning, right? So 18 to 20 price to earning is what I believe that a fair valuation of the market and stock is, right? So that number I have in my head, right? Now what happens is I try to adjust this multiple with few factors, right? And based on that, I decide that at what multiple a particular stock should be when I'm buying a stock, right? And these factors are as follows, right? The first one is the market cycle, right? This multiple, if we are in a bull market, then probably you know that multiple tends to be higher, or and in case of bear market, it tends to be low, right? So that's the first factor. So the second factor is the quality of business, right? So a business can be a good, bad, or ugly, right? And the way to identify a quality of the business, I would say in terms of quantitative parameter, I would say is ROE, return on equity. Companies which generate more than 20% ROE, I would say that those companies are good business. And the companies who generate less than 10% are probably ugly business, or kind of holder wealth destroyer business, right? So the companies who are good will get a premium to that multiple, and vice versa. Then the third type of business are the business type, which can be again divided into three types. One is the star, one is the cash cow, and third is the growth trap. Star business are those business which are basically having a good business model, quality of business is good, and they can continue to grow at a 20-25% growth rate. So companies which can grow at 20-25% growth rate and has a 20-25% ROE, those are super business and probably should get a fairly good premium compared to the market. I mean, right? So the business which we have, I mean, we have all seen likes of Bajaj Finance and other players command premium valuation, and the reason for that is they belong to those categories. Then the player who are cash cow, like FMCG players, that they have a good ROE, but they cannot grow at a higher rate of return, right? So they cannot grow at a higher rate of return, so they should get a relatively lesser multiple compared to the star business, right? So that's the business thing. Then third is the management pedigree. Good management obviously get better multiple. Then after that, the growth drivers, right? So if you see a sector wherein you believe that there's a structural trend in place for the next 5 to 10 years, there you will get a better multiple compared to a cyclical sector like commodity, wherein the trend could be just for 2 to 3 years, right? Then the other sector to look at is the opportunity size, right? Overall market size of the opportunity. In that sense, if there's a player who is just shark in the ocean, that opportunity size is huge, and player is a significant player in that industry, then a shark in the ocean will get a highest multiple amongst the player in that space, and then fish in the ocean. A smaller player in that large opportunity will get a lower multiple compared to that player. But if there's a market size which is a pretty small, it's a pond basically, then that player will get lesser multiple than the fish in the ocean. So and so on and so forth. So that's the another factor to look at, right? Then the last factor is the risk profile. A company which is debt free, right, will get a better multiple than company which has a debt, right? So what I do is basically I have this mental model of in my head that this is the multiple a company should get it. Then I adjust my stock with these parameter, and based on that I come up with a multiple, that this is the multiple this company should get. This is the earning this company is expected to have, right? And that is the level of target this particular stock should go reach at. This is the entry price, and I see risk reward to be good, and that is how I plan the entry and then exit.
Right, Ravi. So, Ravi, there are few questions in the comments. Let me read it out. So, there is one question from Sansar. So, am I audible, Ravi? Right?
Yes, yes, yes.
Okay. So he's asking like, if how would you design a 2 crore portfolio in terms of allocation in market cap, and what should be the maximum position in any stock?
So basically, Prince, I would put it this way that it's a function of somebody's style and strategy, right? So and this appetite, right? So basically, allocation to the market, right? Basically, allocation to the market, and then from the market to the small cap, mid cap, or large cap is a function of a risk appetite of a person and the kind of drawdown he is expected to witness, right? If somebody is is happy or will not react to a, let's say, 30 to 40% fall in the folio, then probably it would be wise for him to have a relatively high allocation to the small cap. But if somebody is basically doesn't want to take in 30% or 40% kind of drawdown, then probably he should just stick to the large cap, right? So that way, the allocation to the small cap and large cap is a function of risk appetite, right? So I'll not be able to comment on, how one should design is on the risk appetite, right? Then second is within the stock, right? So what happens is generally there's a good principle that good wealth gets created when there is a concentrated portfolio. I mean, around, let's say, 10 stocks in the portfolio. That is when a good wealth gets created. Because there is a saying that, a, a stock with a 2% allocation, if it goes 10x, it barely moves the needle, right? So you need to have a high allocation to your conviction stock. So that way, one needs to have 8 to 10 stocks, but that again will be a function of the conviction one has, right? If somebody has done a detailed work on let's say 5 stocks, and he knows inside out of about those stocks, and he understands that when to get in or when to get out of those stocks, then probably he can have higher allocation. But if somebody is not sure about the stock, then probably it is better to have a diversified portfolio. So that way, it actually comes down to individual style of investing, I would say.
Right, Ravi. So blank space, you can unmute and ask your question.
Hello, hi. Ravi ji, actually, I had a couple of questions. मैं पहला वाला बोलता हूँ. तो I'm very fine with screening stocks using screener. So I can apply all ratios, everything. पर फिर दिक्कत क्या आती है उसके बाद में फिर अगर मैं ले भी आऊँ 40 50 30 40 स्मॉल कैप के लिस्ट उसमें फिर फर्दर डीप डाउन करना है टू सिलेक्ट द राइट वंस उसमें मैं थोड़ा सा स्ट्रगल कर जाता हूँ क्योंकि कभी मेरे को लगता है कि मेरे पास इतना इन्फॉर्मेशन नहीं है एंड जो इन्फॉर्मेशन मैं पढ़ता हूँ मेरे को जनरली मेजोरिटी सबके लिए पॉजिटिव लगता है तो आई थिंक वहाँ पे फ्रॉम व्हाट आई थिंक वेर आई लाइक इज द रिसर्च वेर आई शुड डीप डाइव इन मोर पर आई डोंट नो वो मेरा भी फिलहाल रिस्ट्रिक्शन बन रहा है कि मैं कर नहीं पा रहा हूँ तो मैं भी 3 साल से इन्वेस्टिंग कर रहा हूँ आपके लिए उसके लिए कोई एडवाइस है कि मैं वो कहा कैसे डिकोड कर सकता हूँ हाउ कैन आई गेट बेटर एट दैट.
So I think from that sense, so out of let's say 40 stocks which are finding, right? So you have to basically look at, out of those 40 stocks, where do you get comfort in terms of the information the most? I mean, let's say out of 40 stocks, you have to choose 15, 20 stocks where you get the most comfort in terms of the information, in terms of your sector knowledge, or in terms of the uh, data points you're getting, right? Then out of those stocks, basically you have to dig deeper and get into your comfort area, right? And based on that, you have to choose a stock. So, you see, you have to understand one thing that as an individual, you cannot study 15, 20 companies in detail, and you cannot apply 10 strategy in one go, right? So that way you have to choose your niche, you have to choose your sector or particular theme, and then you have to work accordingly. Otherwise, what would happen is, I mean, you will end up doing nothing actually. So you have to define your niche area and then work accordingly.
ओके थैंक यू सो मच एंड एक और मेरा एक्चुअली काफ़ी है फिर मैं एक और पूछ सकता फिर बाद में टाइम मिला तो मैं वापस आता हूँ जैसे आपने अभी बोले इसमें कि आई आई हैव टू पिक अप नीश एंड आई हैव टू स्टडी सेक्टर्स तो एज अ जब जैसे आप अगर आप अपना बता पाए कि जैसे आपने स्टार्ट किए थे जैसे अभी आपने एग्जैक्टली जो बोले वही इशू होता है कि बहुत सारे शेयर्स निकाल देता हूँ मैं एंड आई एंड अप रीडिंग अ लॉट सबका सबका अलग अलग होता है एंड इट ऑल गेट्स कंफ्यूजिंग एंड आई डू नॉट एंड अप इन्वेस्टिंग इन द शेयर्स आई वुड लाइक तो वो कंफ्यूजन में अटक जाता हूँ तो what should be how should one decide that thing कि कौन से sectors one should pick and secondly how much information should be good enough because now in this era we have endless information I mean we can go everywhere and we'll find something or the other तो मैं कैसे decide करूँ कि this is the perfect information that I'm picking up and efficiency best है and I'm consuming the best information is one issue because अभी मैं कोई छोटी कंपनी पकड़ लूँ, मैं कभी ट्राई करता हूँ मैं कोई बड़ी कंपनी ढूंढूं उसका, फिर उसका रिपोर्ट्स पढूं, फिर वो इंडस्ट्री पढ़ लूँ, तो उसमें मेरे को लगता है आई गेट लॉस्ट, आई एम नॉट हियर, आई एम नॉट देयर, मैं गलत गलत इन्फॉर्मेशन कंज्यूम कर रहा हूँ एंड फिर वो टाइम गैप आ जाता है जैसे आपने पहले बोले कि एक हफ्ता निकल जाएगा एंड मे बी शेयर रन अप आ जाएगा एंड वैसी चीजें। तो हाउ शुड आई टारगेट टू कंज्यूम द बेस्ट इन्फॉर्मेशन फॉर स्मॉल कैप एंड मिड कैप?
Right. So I think there are two parts to your question, right? So first part is that how to pick the niche. So there I would put it this way that you have to you start with a one particular strategy, and then whatever stocks are coming in that particular strategy, so that is the starting point. For example, in the bottom-up approach of investing, I gave you example that post-earning announcement drift is one strategy. So if you follow that in a quarter, you will come across few companies. So that is a starting point for you. Similarly, if you look at the management change strategy, so that is a starting point for you. If you go by the sector, then probably you will have to start with one sector or maximum two sector, and whatever stocks are there in those sectors, you have to focus there, right? So I think that's how you have to look at the first part of identifying a niche. How I did is back in 2011 to 13, I was actually working with an institutional equity research company as an analyst, right? So I was looking at the automobile sector, right? So that is how I started. I started with the automobile sector, and then gradually kept on building to the different sectors. And then at this point of time, with so much year of experience, I have some understanding about each and every sector and most of the companies. Some understanding, right? So that way it is easy to comprehend. So this gets built up over the time. But to start with, you have to choose one particular niche either based on a strategy or sector. Now for the information, see, prima facie, what do you need to understand? You need to understand few things, that there has to be a management comfort in the company. Second is there has to be earning tailwind. In simple term, if there is an earning tailwind with the company in any way, I mean, either it could be because of the sector tailwind or it could be because of the company specific things. So if there is an earning tailwind in the company, and if earning is going to see if company is going to see a good number, there will be return which will get made. The third part is the valuation. If you believe that valuation is cheap and you see the earning potential, then probably you can get into the stock without thinking much. But if you believe that that valuation is not cheap, then probably you have to increase your effort. If valuation is expensive, then probably it is not wise to continue in that stock in terms of the effort, because as a retail investor, you will not get the edge which other people may have, right? So I would say that it's a combination of two factors, that valuation as well as the earning trigger. And if you get comfort on both of them, then probably I think that is the way to go about it.
Okay, thank you so much, Saviji. And Princely, if I can just ask one more question and then I'd love to hear other minds. एक छोटा सा सवाल है, सो माय पोर्टफोलियो साइज, माय पर्सनल पोर्टफोलियो, मेरा खुद का या माय पेरेंट्स का एक्सक्लूडिंग, इट्स अराउंड 30 lakhs। तो मेरे को एक चीज जानना था कि आई एम ओके विद टेकिंग अ लॉट ऑफ रिस्क। तो मेरे को एक चीज है कि मैं आज तक अभी एसएमई आईपीओ में अप्लाई नहीं किया बिकॉज द वे स्मॉल का मिड का फंक्शन, जब करेक्शन आना है तब आ सकता है, बुरा तरीका आ सकता है। सो दैट हैज बीन एन इशू कि मैं इसीलिए अभी तक वो जो स्पेसिफिक मिनिमम 2 लाख इन्वेस्टमेंट है वो मैं अभी तक कर नहीं पाया हूँ एक्चुअली। तो वो एक रिस्क एपेटाइट के चक्कर में कि मेरा पोर्टफोलियो साइज इतना बड़ा नहीं है बिफोर टेकिंग दैट रिस्क। आई एम ओके विद टेकिंग दोस रिस्क कि करेक्शन आएगा, मेरी ओके विद इट। बट व्हाट इज अ प्रूडेंट वे एंड फ्रॉम व्हेन शुड वन स्टार्ट थिंकिंग ऑफ इन्वेस्टिंग इन सच स्टॉक्स कि ऑन अ
See,
पोर्टफोलियो
basically,
लेवल जो थोड़ा सेंस बने? हाँ, थैंक यू।
yeah. So basically, if you look at, I mean, SME stocks, generally the ticket size is 3 lakh to 4 lakh, which on a portfolio level of, let's say, 30 lakh would works out to be 10%, right? So putting 10% in one script, that to SME would not be wise actually, right? So as a general principle, what happens is there is not much scrutiny or much, there is not good corporate governance practice being followed by the SME company generally. There are exception, obviously. There are good companies in the SME space as well, but on a generally principle basis, uh, corporate governance practices are not that great, right? So from that sense, I would say that I mean, if you are in the beginning of your career in the investment, then generally one should avoid the SME until and unless you have a fairly good comfort on how to analyze the company, and probably if you have spoken to the companies. Otherwise, it is best to avoid those companies. Is my view, right? Uh, I know that there's a good money which gets made in the SME, right? But in order to make that good money, you need to have a full detailed understanding of the company. You have to meet the company. You have to visit the plant, right? That is the only way to do it. Otherwise, sitting on a laptop and then researching about the company, I don't think there'll be good output with the SME companies.
All right, Ravi. Thank you. Blank space for your questions. Yeah. So Ravi, like moving on to next, like the changing dynamics in the market. So how one should approach market, say in current environment.
Yeah, so basically, as I covered briefly during the earlier part of conversation, so basically what I believe is, stock market volatility has basically increased a lot over the last few years. So as a result of which, the buy and hold mindset, which all of us has because of the books which we have read and because of the things which we have listened in the past, that needs to be changed. I mean, there has to be mindset for the buy and rotate because what is happening is all the information which is there in the market is available in the abundance, and all those information gets disseminated very very fast, right? Then what is happening is market speculation or the momentum or trading activity also has increased a lot in the market, right? So because of which what is happening is gets stocks factor the price too often too fast, right? So as a result of which, what happens is there's a extreme exuberance on the upside. At the same time, on the downside, there's a high panic in the stocks, right? So because of all these things, what we have to do is we need to have a proper system in place, right? We need to make sure that, as I mentioned earlier, that if you are liking the stock, you have to get in really fast, right? Then a theme or stock keeps on changing a lot, you have to exit really fast, right? So that is how you have to behave, and you need to come out of that buy and hold mindset. So buy and hold is good from the portfolio perspective, that you have to stay investing in the market. That's the buy and hold mindset you need to have. But buy and hold a stock is probably not a good mindset, and that needs to change. Even if you look at the market data of the last 3 years, the people who have done well are actually the people who were of this philosophy. And the people who were of the traditional philosophy, right, that they want to sit on a particular stock, a particular theme, and want to wait for 5 years, 10 years, they have not done well, right? Then the second thing is you need to understand this thing that the fun is not to buy at bottom and sell at top, from the stock perspective. The fun is to buy the stock at an inflection point when the move gets started in a particular stock, and then sell it. So probably buy high and sell higher should be the mantra. So that way I will say that market dynamics which used to be earlier had changed a lot. Disruption keeps on coming very fast, which disrupt the market environment as well as the sector environment and the company's environment. And in turn, those affect the portfolio positioning also, right? So as and when these things change, you have to reposition your portfolio to get benefited out of the market environment.
Right, right, Ravi. So, Ravi, like people are very inquisitive when it comes to the current market situation. So, what's your view on the current market situation? And there are many sectors of the likes of, say, IT, pharma, and maybe uh, other sectors which I mean obviously the metals and commodities, and people are like have so many questions around these sectors. So do you have any view on these sectors, and how you view the current market situation?
Yeah. Okay. So, to answer your question, I mean, let me say that, there's a very clear pattern which works perfectly in the market, right? And there's a pretty good correlation between the various asset classes, right? So I track basically commodity, crypto, equity, and bonds and everything, right? And USD index as well. So that way, I mean, if you track all of that, there's a pretty good signal which we keep on getting at every point of time, right? So if you look at the look at the last bull market, which started post COVID, right? So global market made bottom around end of March 2020, right? Post that, what happened is Nasdaq was the first indices which had hit the new high, right? Globally, if you look at Nasdaq was the first index when it made new high. So that way, it was the leader of the bull market, and the other indices followed, right? And then what happened is when inflation started increasing because of the Fed liquidity infusion and all those things, when inflation started increasing, right? So there was a chatter in the market that now Fed has to reverse its stance and they have to start increasing rate. But obviously they were late, right? But market was efficient to realize this, and Nasdaq actually topped out back in November 2021, right? Although we came to know about in January, by January 2022, Nasdaq was down 20%, and officially it came in the bear market. Crypto also made top by that time, and the major things were down by that time. But other indices were holding on, right? Even in India, we were not down much actually, right? So that was a point of time when we had a signal that the leader of the bull market, Nasdaq, is actually going into the bear market. That was the first signal we had. And on the fundamental side of it, we clearly had a signal that inflation is pretty high, and then Fed has no choice but to increase interest rate now, right? And valuation were expensive, so there were pretty good signal with us that the market has topped out, right? And then thereafter, we know that how things have panned out across the market and everything. Now, on the vice versa, now if you look at what happens is, as there is the euphoria at the peak, there's a panic in the bottom, right? Generally, what happens is market bottoms out whenever there's a major accident in the market, right? So what happened is back in October, November 2022, in the crypto market, there was a massive fraud which happened, FTX saga which happened, right? But post that saga also, crypto did not go down much. That was a signal then probably that this market has bottomed out, right? Then Nasdaq was rallying from that time, but obviously, right, we didn't know that has market bottomed out or what, right? Then signals started coming up from December 2022 onwards that probably since the commodity prices fell a lot, that since the commodity price has fallen, so inflation number will also come down now. It's just a matter of time, right? And Fed will have to reverse its stance pretty soon, right? So we had the pretty good signal at that point of time. Then what happened is this saga which happened now, banking crisis, this banking crisis, happened, but at that point of time also, on this banking crisis, we did not fall much actually. If you look at the large indices in US, we did not fall much. And in fact, this prompted Fed to reverse its stance, and now they are injecting liquidity and will probably end the interest rate cycle soon, right? So that way, we have a pretty good evidence that the 18 month of bear market is ending because Fed is going to reverse its stance. Valuations are decent. Third, on the major, this accident market has not fallen much. And then the fourth point, Nasdaq index, which was first to make new high back in last bull market, first to go into the bear market, is actually the first index to move more than 20%. So if you look at from the bottom, it has moved up more than 20%. So that way, if you put together everything, there's a pretty good evidence with us which says that market has bottomed out. Nasdaq is leading as of now, and probably the other indices would follow soon, right? So that's the view which is there from the market perspective. But there's a but things are not that easy from the macro point of view. What is happening is now Fed has to reverse the stance. But then in that attempt, what would happen is inflation will not come down. I mean, obviously it has come down from the peak level, but it will not go to 1 to 2% sort of number, right? And if it does not go to 2% sort of number, then there will be issues and there will be things which will blow up in the US. So that way, there is a chances that things will blow up in the future as well. But Fed has no other way but to basically continue with the, but to stop the interest rate hike. So that way, what I believe is market has probably bottomed out. We will do well, and probably inflation also will not come down. So we are going to witness a inflation bubble, be it in the end consumer product prices or be in the asset. So probably we will witness asset inflation as well as the raw material inflation going forward. So that way, all the risky indices as well as the risk-free instrument like gold and silver, everything will do well from that point of view.
Okay. And specific to the sectors, Ravi, IT and the metals and commodities. I mean,
So that way, so what is happening, Prince, that from the IT sector point of view, IT companies had a major tailwind in terms of the earning from in the last 2.5 years, right? But now their cost overheads are also quite high. So I don't have a basically a much positive view on the IT sector as such, right? And then you were asking about the pharma also. So pharma sector also I am not much bullish, but I believe is probably this in India per se defense theme, manufacturing theme, probably the capital goods theme is something which will do well, right? So the one major trend which I see across the world is that all the countries are doing a lot of capex, right? Either they are investing in the manufacturing base or defense. So that way, manufacturing theme, right? Sub theme within that capital goods, manufacturing, defense. I think that is one theme which will do well, right? Apart from that, I don't see a major, sectoral trend as of now, right? This sectoral trend again will become more visible over the next few quarters, right? But on a company specific level, I believe there are a lot of companies who have done a lot of capex over the last few years, and they will start reaping benefit of that capex in the upcoming years. And those companies are available at a decent valuation also. So that way, I believe that probably the bottom of approach of investing would be a better approach. Let's say from the next 1.5 year perspective, or in the top down, probably a manufacturing thing.
right, Ravi. Anand, you can unmute and ask your question to Ravi.
Yeah, yeah. Thank you. I want to ask that how one can plan for the retirement if a person has 30 years to retire.
Mhm. See, if somebody is a 30 year to retire, I mean, so this is a personal finance question. But to answer the question, so basically, what you have to do is that you have to understand that what is your annual expenses today, right? Then you have to assume an inflation rate and see that, let's say you want to retire at the age of 55, right? At the age of 25, how much amount you need to have in your kitty so that you can live your retirement life. And then over the next 25 years, obviously you have to define few goals, right? Few life goals, whatever you want to buy. If you don't have a house, you want to buy a house, or for your kids' study and all those things. So you have to see how much corpus you need to have over the next few years. Then that corpus, you have to basically see that if you're investing in the equity, probably it will be wise to assume low double digit kind of return in the longer term. So if you can achieve those numbers, then how much probably investment you need to do on a consistent basis. So that is how I think one can plan for the retirement. So that way, I mean, some amount, whatever surplus amount you have as of now, assume that to be your investment amount, and then every month assume some amount to be your investment amount, whatever you can save, 20, 30, 40% of your income, whatever you can save. Assume 10 12% return to be on a conservative side, right? Although you can achieve higher also, but it's always wise to assume that return and see where are you reaching after 10 years when you may have some requirement of the fund for, let's say, for your kids higher study or whatever. Then 20 years, and then I think that is how you have to plan it.
Right,
And which
Ravi.
asset class one should follow?
See, so that way there is a general principle from the investing perspective is that you need to have a health insurance in place. You need to have your house in place. You don't need to have any debt with you. Apart from that, some emergency fund you should have in fixed deposit or liquid fund. Then apart from that, your age minus your 100 minus your age, which is 30-year age, right? So 70% amount is what you can have in your equity portfolio, is basically the rule.
Okay, thank you.
Thank you, Anand. Ravi, the behavior is one thing which fluctuates the most, right? So, how
Yeah.
do you handle noise in market situations, especially because it is very difficult for, investors to control their behavior, and market is all about observing behavior of others and acting accordingly. So, what's your, recipe of handling noise in the market?
So there are different ways to see. One thing is, Prince, what happens is, these things comes with the experience, right? And then even what experience tells us is that whenever there's a panic in the market, everyone panics, right? Someone panic less and someone panic more. That is the only difference, right? So that way, I will say that if your position is such that you are not leveraged, or you are not into the risky stock, or you're into the well researched stocks, right? So probably that way you will not panic much, right? And that is what your objective should be. Then the other thing to look at is, as I mentioned, you need to have some view on the market, right? Based on the market cycle, valuation cycle, and everything. And that way, if you believe that probably, we are nearing the peak or bottom, that way you have to take some call, right? In the sense that, it is always better to panic early than to panic late, right? So that way, if you believe that probably we are at the peak end of the market, maybe peak is coming after 6 months or 1 year, so you can start, reduce you can start going into the conservative mode. So there are different ways of doing it. For example, if I have to take example of myself, back in 2018, I had a view that market is basically peaking out, but I don't know that we peak be 3 months after or 6 months after. So I don't know, I didn't know that. So but what I did is, at that point of time, I was into the micro cap stock, I was into the small cap, and I was into the SME also. So what I did is, I knew that top is coming near. So I exited from the SME stocks and micro cap stocks, and shifted my folio more towards the mid cap, right? With the view that if there is a market fall, at least I should be able to get liquidity. I should be able to sell my stocks easily, right? So that is the first thing which I did. Right. The second, when I started getting the evidence, then what I did is I raised some cash. And on the third instance, what I did is I shifted to the large cap also. Right. So that way, you need to change your beta of your portfolio and strategy depending upon the market environment, right? So it is neither zero or one, right? You cannot get out of the market completely, and you cannot be full in the market at all the time. There's a middle path also, right? So you have to you have to practice those things, so that if things go south, you have the plan in place, right? So that's the way to go after in the panic situation.
Right, Ravi. So, Ravi, tell us about your fintech startup a bit.
Yeah. So basically, Prince, as some of the people would know that, basically, I invest in multiple asset classes, right? And, I started looking at the blockchain space back in 2017, right? So I'm kind of fascinated with this stuff which is happening in the blockchain space. But yes, there things are on the crypto side as well, which is not regulated. So we had a view that, the blockchain is a real application, blockchain is a real technology, right? So using blockchain in a legally compliant manner, we can do a lot of things, right? So from that sense, what we are doing is we are tokenizing real world assets like fixed deposit, bond, equity, mutual fund, tokenizing those assets using the blockchain technology and bringing them on our platform, which is a Blostem platform. Then what we are doing is we are enabling secure lending against that, right? If you notice over the last few years, a lot of innovation has happened on the fintech side of it, and a lot of lending app has come up, but everybody is focused on the unsecured lending, right? We want to solve the secured lending problem. Imagine a situation that as a customer, if everything goes well, our vision is that, at the end of the day, you will be able to witness all of your assets at one place, and using any platform, be it our platform or our partner platform, you will be able to get a instant secure lending secure loan at a very cheaper interest rate, right? So that's the problem we are trying to solve.
Great. So Ravi, like we all make n number of mistakes in the market. So we have talked about everything. So let's talk a little bit about your learnings and mistakes in the market.
Yeah. So there are multiple things. So basically, as I mentioned, I started investment back in 2006, right? So during 2006 to 8, obviously I was novice. So what happened is, I mean, we used to discuss with our relative, and then based on that, we used to buy. I mean, based on the tips and all those things, right? What happened is in 2018, again, I mean, as everyone did, we also participated in Reliance Power IPO, right? And then, uh, we had all those kind of stock, Reliance Power, JP Associate, and Suzlon, and all those things, right? And then as price kept it falling, we kept on, buying on the dip. So we kept on averaging on the downside, right? That way, by the end of 2009, we had three, four stocks in our portfolio and all were down 80-90%, right? So that way, I mean, that was a big mistake we did. But the good thing is that was on a very, very low portfolio size, right? So I mean, that mistake was huge in terms of the percentage, but on absolute level, it was low. But we had all the junk stock in our portfolio, right? So that was a one learning for me. And post that, when I started reading about the equity, did research and all those things, so these things started improving. But again, I mean, back in 2013, 14, so I was bullish on auto actually that point of time, played a couple of good stocks like Forging is one stock which I played at that point of time. After that, Forging was doing well and I made good money. But then there was a company called Ahmednagar Forging at that point of time. So I invested in that company, and then what happened is group was not doing well. There was a corporate governance issue, default happened, and then stock tanked 60-70%, right? So a lot of losses happened in that script, right? And after that also, I mean, at every point of time, every year or so, some mistakes keeps on happening. Last year there was a company called Chamcon, right? So that company looked cheap, right? But corporate governance were not good, and then result came bad. So we lost around 30-40% in that stock also. So that way, I mean, mistake kept on happening. Obviously, I mean, every year or so, or uh, sometime more, sometime less. But the idea is that over the last year, what I have done is mistake do happen, and I believe mistake will happen in the future. But you need to have a position sizing or risk practices in a manner that even if you lose, you don't lose much, basically, right? So that way, what I have done is now I don't take more than, let's say, 15% exposure in a particular stock, right? And then second thing is I have a rule in mind that if market is not going down, right? If market is flat, and if my stock is going down 20-25%, that I need to get out of that stock, right? So that way you can say this is the mental stop loss I have put. And if market is going down, right, and if my stock is going down much more than the market, despite I mean much more than it should have gone based on the beta, then also I tend to exit probably from that stock. So that's the learning I try to apply now to avoid the major accidents.
So Ravi, any incident when you missed out on predicting the market cycle or maybe the economy cycle correctly and accordingly placed bets and that went wrong? Any example to your mind or?
Yeah, so basically what happens is, even in the 2020 crisis, so I tell you in 2018, uh, 2019, I wrote a post that, market will bottom out when these events will happen, right? And those events exactly happen at the March end, right? But I also forgot those things, right? Since I also have emotion, right? So probably I didn't time the bottom back in March 2020, right? But what I do is, I use quantitative methods also. So what happened is by the mid-April 2020, a lot of indication started coming in, which was telling me that probably the market may have bottom and we may see good rally, right? But I was in denial mode. But by the end of April, few more signal came in, and then I got into the market, right? So that way, you can say that from March end till April end, so around a 1 month move, which was around 15-20% move in the market, that I missed, right? But that did not cause much issue to me because I was able to get out of the market right at a good time. I mean, exactly on 24th Feb 2020. Post that market fell 40%, so I was able to get in when market was down around 30%. So that way, that mistake didn't cost me much, right? So and that way I will say it this way that uh, if I had not used this top down approach over the last 5-6 years, my portfolio would have been X. But because of this approach, my portfolio is actually 2X. So that way, I mean, there's a decent alpha which I've been able to generate because of these things. And then if you can top it up with the good stocks, then that is just the additional icing on the cake, basically.
Right. So, Ravi, like when it comes to risk management, so that is the most important aspect in investing, right? And we cannot there are risks which are unknown to us, right? So we cannot avoid that. But so as to sail through in times of uncertainty and maybe placing ourselves in such a manner so that the impact on the downside is minimum. So, I mean, apart from whatever we have discussed so far, any other pointers come to your mind which is like basically a part of risk management on your part?
So basically, so what I do, see, there on my part also and otherwise also, I'd like to share a few things with the people here. See, first of all, see, one general advice I would like to give is stay away from the future and option market, right? Don't get lured by the screenshots or things you see on the social media. I mean, obviously there are people who are making good money in the future and options, but generally what I have seen is people lose money in the future option more often than making money. And there's a saying that Rome was not built in a day, but Hiroshima and Nagasaki was destroyed in a day. So that way, through the F&O, you may make money, 360 days out of 365, but in 5 days, you may lose more than what you have made. So first, risk management practice is to avoid F&O, but still, if you want to have a thrill of F&O, have a separate account and keep maybe 5% or maximum 10% of your money there, right? So that's the first advice. Second is when you are investing in the market, you have to understand that market is not a get quick rich scheme, right? It's a place wherein if you do systematically, you can make good wealth, but you have to follow good practices. By good practices, what you have to do is you have to only invest that money in the market which you believe you will not require to take out over the next 5 years. So that if market goes southward, you don't panic. That's the first principle. Second, when you're investing, right? Generally, I would advise that have at least 15 stocks in the portfolio and a bit diversified from the theme perspective and from the sector perspective, so that even if some bets go wrong, other stocks will be able to make out for your loss, and at a portfolio level you will not lose much. Third thing is always try to hold on to the winner and sell the losers. People do opposite. People want to get out of the stocks where they have profit and they want to continue holding the loser stock, right? But my experience is that you'll make good money if you keep on getting out of the losers and keep on holding on to the winners. So that way what will happen is you will have only good stocks in your portfolio because the losers you kept on selling and the winners you kept on adding. So every point of time you will have a good portfolio. Then never average on the downside and always average on the upside, right? So I think these are the some of the principles which one should follow, and that way one will do well. And the other thing to keep in mind is this, right? If you follow this practice, right, you will not go out of the market, right? And if you don't go out of the market, right, Whether you make 15%, 20%, or 30%, you will make good money. If not in 10 years, in 15 years or 20 years. But you will surely make good money, right? So the idea is to have a risk management practices in place, the points which I mentioned, and then try to improve on the returns part, right? Even if you are able to make, let's say, 10 12% returns, that's good enough from the 20 year point of view, right? If you can make 20% return, that's a pretty good return. And if you're able to make 30%, I mean, that's a fantastic return, right? And so that's my advice to the everyone.
Yeah. So Ravi, any good books or maybe any literature on investing which you would suggest to our attendees, which was helpful for you and they may also benefit from it? And like up to what limit you think books can help as far as investing is concerned?
See, I believe that basic investing principle or skills can be learned through the books, right? So there are different books there. Mastering the Art of Cycle is one book, right? Then on the valuation, there are different books. So that is the basic thing one can do. But I think more learning and more experience comes by reading the annual report of the company, by going to the conference call of the companies, by going through research reports of the company. So I think that add more value compared to the books, right? So that way, I will say that the time has to be spent more on the company reading than the books reading.
Right. And Ravi, one question often is like, see, when it comes to passive investing or maybe index investing, that doesn't give you much thrill as the moment in any stock gives, right? So when we start our journey, so normally we have a tendency to get attracted towards direct equity investing. So how to control that urge in the initial phase of 5 years and go about investing in passive manner and gradually, as you said, read annual report and con calls, etc. So what should be, I mean, an ideal approach in your view for at least who are beginning, just beginning?
Yeah, I think see, one is to make money and one is to have that urge, or thrill, right? So both are different things, right? So that way I will say that one should keep in mind the objective is not to have a thrill but to make money. From that sense, ideally, to start with, one should start more with the index investing, or in the large cap, or through some advisors whom they believe is good, or maybe through mutual fund, right? But if they want to do direct investing, so probably what can happen is there can be two portfolio, wherein the initially 70 to 80% of the part can be through that passive investing, and 20% part could be through the direct investing, right? And they should monitor the performance over the next 2 to 3 years, that how the performance is happening in the direct investing and the passive investing. And if the result is that you are able to beat the passive investing through the direct investing, then probably one should increase the direct investing part. Otherwise, I think one should continue that way only. That returns gets generated through the passive part, and your thrill objective gets fulfilled through that 15-20% part.
Right. So, Ravi, like we normally listen from people who have spent decades in the market. Say, so they normally say like at least when you experience two bull markets and two bear markets, then you get a true sense of what market is all about. So, how had your experience been? Like you started way off in the year 2006. So, when you think like your journey started to mature and you get a sense like market is one place which is totally made for me or maybe I'm made for market.
So I would say this, that probably 2016 onward is when I I could say that I kind of became good in the market. That I could say that I have some understanding of the market, right? And I think in 2018 we had a clear signal that market is topping out, and after that, the 2018 bear market when we had, right? So all the notes which I had and all the things which I read, I could witness all those things actually playing out in the market, right? Which gave me the confidence that yes, I was right in my thesis and I could see all those things playing out. Similarly, when the bull market started, we have read about a denial which generally happens in the bull market. I could see that happening, right? And now, I mean, it is easier for me to relate to the bull market and bear market since I've seen those cycles. Because in every cycle, when there's a euphoria, people will say this time is different and we are not going to fall. This will happen every time. Similarly, whenever there's a panic, people will say that things are not going to look good, and we are going to go down a lot more, right? That also happens every time in the bear market, right? And once you witness that once or twice, then third time also that this is what is going to happen, right? So I think that's why people say that once you witness two bull or bear market, you will be able to relate with the signals, with the patterns, and with the news, and you will be able to take a wiser decision compared to what you would have taken in the previous cycle. And
So
believe me, patterns are exactly same, 90% same in all the bull and bear market.
yeah, I can relate that because more or less the human behavior is one thing which remains more or less the same. So Ravi, one question
Yeah.
is around. Okay, let me see what was that. Uh, these okay. So, yeah. So when it comes to forensics, so what all quick checks you can suggest to our attendees? Because there are times that what we say, the accountants are the smart people and they can fudge the reports, and that could be misleading for at least the novice people in the market. So what would be your I mean sanity check in the sense as far as forensics are concerned?
Yeah, so basically, it start with the promoter, right? So you need to understand, you have to read a bit about the promoter, that what he has done in the past, right? Has there been any default or any corporate governance issue in the past with the particular company, right? So that's the first thing you have to see. Second is the promoter holding, right? Generally, if a company has a low promoter holding, then generally that is a bad signal. I mean, not always, but generally it's a bad signal, right? Third thing is audit qualification in past. If you have seen that in the past, company has seen any auditor qualification in its financials, that's a negative. Then the other thing to look at is basically your cash flow, right? So that's a very important point, that cash flow from operation to PAT ratio, right? That ratio has to be near one over a longer period of time. Over the, let's say, 10-year period of time, it has to be near one, right? If not, if it is less than one, then probably you need to dig deeper, right? Then second thing is, and you have to dig deeper and probably you have to compare it with the peers, right? If in the same sector there's another company who has a cash flow to operation CFO to PAT ratio of around one, and this company has a point 0.5, then probably this company is cycling money, right? Similarly, if the both companies are in the similar business and one has a very low margin and another has a good margins, right? So that way, probably one company is doing something really wrong and some other company is doing something really good, right? Other point to look at is a lot of companies, what they do is they keep on doing aggressive capex, right? They say that we are doing a capex, but that capex does not result into much of the revenue. So your asset turnover ratio is something which you need to look at, and that asset turnover ratio, let's say for a particular company in the industry is 2 and the other company in the industry is 4, then probably the company which has a lower asset turnover ratio, either they are siphoning money by the way of capex, or it could be vice versa, that the company which has a higher turnover ratio, maybe they are having the aggressive revenue recognition policy, right? So that's the other way of siphoning money, right? Then the account receivable ratio, right? If account receivable days are continuously increasing, then probably what is happening is company is booking revenue in its books, but parking that money in the receivable form. So that's the another way of checking it. So I think these are 7 to 8 parameters wherein you'll be able to find out whether company is doing any fudging with the accounting. Generally, cash flow from operation is a single most parameter which one should look at in detail. And to look at that in detail, I mean, account receivable is one thing, inventory is another thing. So that's how we need to divide basically.
Right, Ravi, right. So Ravi, almost like the questions in the comments and which came to mind have been covered. I see there were many requests, but I couldn't approve owing to Twitter glitch, I guess. So anything which you missed on, like which you had in mind and want to share, or any closing thoughts in your mind before we wrap up for today?
I think most part of it we have already covered. I mean, in the sense that the idea was to share different strategies, right? And each of the strategy are detailed in nature, and one can have his own niche based on this on a particular strategy. For example, in the bottom up approach, I shared three, four strategies. So if one can start practicing just one of them, I think it would give good result, right? And I think on the risk management part also, I've already explained that have a strategy in place wherein don't get out of the market. Your objective should be to be in the market for the next 20 years, right? If you are 30 year of age and can remain in the market for 20 years, you will be at a pretty good place after 20 years. So I think that's the message one should have in mind. That's the one takeaway one should have in mind. And then, returns is a function of your practice, right? And that will also keep on improving as you experience, right? And don't have a don't see that this person is making this much return, so I should also be making. So understand one thing in mind that the returns comes with the experience and luck. So both plays a key role, and if you continue working hard, continue learning things, eventually returns will follow. But you have to make sure that you remain in the market for the next 20 years.
Those are some great advices, I must say. Staying the course, finding your niche, and you should not be comparing yourself to others, and having rational expectations in the market and following a process. These are few things which we focus on our in our spaces, because naming a stock and saying good, bad, or neutral on a company is not a difficult thing. But again, that might lead for you to be in, I mean, a different state, because you won't be understanding the rationale why one person is having a view on the company, right? If you
Right.
focus on your process and try to take their ideology as a starting point and try to fit in, like identifying the kind of risk you can take and your nature, as Ravi was explaining brilliantly, that market is so volatile, so your appetite has to be in sync with the investing process which you form. So it was great having you today, Ravi, and it was really insightful on your part, and
Yeah,
surely sometime
yeah.
down the
Before that,
line.
yeah. So I just like to add one more thing, please. Hello.
Yeah, yeah, go ahead, please.
Yeah. Yeah. So basically, I would like to thank you also. Thanks for hosting the event. And I must say that you have been doing this Twitter Spaces frequently, and wherein you are bringing various experts and helping the retail investors and educating them, which is really worth appreciating, right? So social media is doing well. I mean, in the sense that people like you are actually bringing the knowledge to these investors, to the retail participants and the ecosystem participants. So that's really good thing. And I've seen that you have recorded videos also on the YouTube channel. So that's really beneficial for everyone. So that way, thanks to you, thanks for hosting, and thanks for bringing everyone on the platform. Yeah.
Thank you so much, Ravi, for your kind words. And it's all because of people like you who readily agree sharing their knowledge with all of us. And surely it is a great value addition, because we get to understand various, like as you were saying, money can be weighed in the market through various ways. The only thing you need to focus is like what is your niche. So likewise, this session is also recorded, and those who joined late can surely revisit to the recording, which I'll be placing over YouTube channel shortly. And if you have any further questions to your mind which you want Ravi to answer, you can surely tag him or me, and surely we will try to address your question, provided it is not a stock specific question in the sense of buy, sell, or hold. And once again, before we close, the conversation was purely educational, and it was done in good intent so as to educate you guys. And if we took any name during the conversation, that is purely for illustration. So please do not construe that as a buy, sell, or hold recommendation. We will strictly ask you to consult your financial advisors in case you want to make any financial decision. So, Ravi, thank you again, and it was great having you today, and surely look forward to many more interactions.
Thank you, Prince.
Thank you,
Thank
everyone,
you,
for
everyone.
keeping so long, and your patience is appreciated. And do participate in our spaces. Surely, we look forward to many more learned experts who are willing to share their part. Yeah, thank you. Good night.
Thank you, everyone.